Welcome to another episode of The Financially Free Investor, where you will learn information and strategies on how to become financially independent by investing in real estate, something that is not taught openly in our society today. Financial freedom matters so you can live a bigger life, retire early, and do what matters most to you. Get ready to hear tried and true methods to becoming financially free with your host, Jordy Clark.
All right, everyone, welcome into another episode of the Financially Free Investor. So this episode is going to be a little bit different than our other episodes. We're actually going to reoccurringly bring this to you every other week. We're calling it the Real Estate Rapid Fire. So I've got my good buddy Jay here. How are you doing, Jay?
I'm ready to spitball some real estate with you.
Sweet. Let's get into it. Jay, since this is the first episode of the Real Estate Rapid Fire that we're going to bring to the people, give the people what they want, why don't you tell us a little bit about yourself?
Well, really looking forward to Jordy. I mean, you and I, Silicon Slopes Capital Partners, I'm a huge data guy. So we started talking about bringing in some of this updated data and just spitball and doing the rapid fire thing, moving that over to your podcast. So I'm really excited to be on with you today. And a little bit about me, just, 30-second version. That's about all it takes. I'm a guy that loves real estate, love my family, and love my job that, believe it or not, doesn't involve real estate. And when I'm not doing that, I'm usually outdoors. So I've been doing real estate since 2008. That was an interesting year. We have bought and sold everything you can imagine, including assisted living facilities, self-storage. We've done some construction. We've kind of done it all. And now with you and Silicon Slopes, we're laser focused on two main things there with the commercial multifamily market and then the single family fund portfolio. So really excited about that. I live in beautiful Park City. I think Salt Lake is a market we're going to be talking about for a long time. Jordy, you and I talked about that a lot. And so I am excited to be here with you and your audience, man. And I love the financial freedom idea. That's super important. And maybe one of the reasons why I'm so happy at work. I love my job. I get to do some really cool stuff, but it all is also really nice to know that I'm financially free. And the reason for that is real estate. Make no mistake about it.
Yeah, it's great, man. Well, I'll say again on the podcast, and we'll definitely have you on for your story and your episode. Man, it just gives you options. One day wake up and say, I don't want to be doing what I'm doing anymore. You can leave the job. And that's what it's all about. Just making sure you're living life intentionally, how you want to live it versus being stuck in a job you hate just because you have to pay bills. So love it, man. Well, dude, let's jump into it. It's end of April when we're recording this, beginning of May. Kind of what's going on in the news, man? You're a data geek. What are you seeing?
Yeah, good thing I'm married because data geek doesn't get you anything in the dating scene these days, but happily married. So yeah, wow. First of all, you talked about April and I thought, what a crazy year it's been, and some people are freaking out and some people are uncertain, but I'm actually kind of having fun because for the first time we're seeing things, the inflation's going crazy. The Feds came out this week. I want to talk a little bit about that later with some, obviously they're rate hiking. They look like they're prepared to be very aggressive there. We haven't seen that in over a decade. So while I have really enjoyed as much as the next commercial guy, the 3% loans, this is going to make us better. We got to knock off some of the dust of our 2012 tools, get our spreadsheets back out and figure out how to buy these things that make sense. And there's going to be some interesting happenings in the market with a little bit of pressure to sell, some loans coming due. It's going to be interesting. And all of that has really happened in the last 3 months, and it's happened fast. So overall, it's like an election year for people that like politics. I'm not a very political guy at all, but they get excited going into election year. I'm kind of excited with all that's going on in the market right now.
Yeah, it's interesting. I think it's definitely gonna, like, we're gonna see a lot of separation. I was on a call the other day where it was another agent and he and I were talking, and he's like, man, this is kind of interesting. And I'm like, dude, get ready, because everyone that says prices can't go down, they'll never go down, rents never go down, like they just haven't owned stuff long enough. Because when you're sitting on a vacancy and you need to fill it, like as a landlord, your option is A, wait longer and maybe get somebody apply, or B, you drop the rent $100 and get it rented, right? Or $200, or you offer a free TV, or $400 off your first month's rent. Like you start offering concessions to get the vacancy filled. So rents can totally go down. I don't think they will, like, very quickly, but they can. But yeah, man, let's dive in. What are you seeing?
Yeah. Well, the thing I really wanted to start with this week came out this week. It came out on Wednesday from Marcus and Millichap. I like those guys. They're knee deep in all of the data, mostly focused on the commercial real estate space. But there's a summary I have here that says, the Fed is already moving aggressively and prepared to continue to move aggressive. And so they did a 25 basis point hike. We all know about that, but the thing that's interesting is that the Fed chairman said he's prepared to do a 50 basis point hike in May, right after the first series of hikes we've seen, like I said, in a decade, and potentially another 5 throughout the course of this year. And I immediately flashed back to, I don't know, 6 months ago, where I'm arguing with so many people that they're talking about Japan and all these places that they're like, there's no way interest rates will ever go back up. And I'm like, yeah, they will. Yeah, they definitely will. No, I don't have a crystal ball on how long they're going up. And I do know that the Fed, the US government now has a easy button. It's a big red easy button somewhere on the desk that they can hit at any given time. And it's the quantitative easing. It's the drop inflation, or drop the interest rate to 0. And they'll hit it. And I'm sure they will. They'll do it. They'll do it again. I just don't know when that's going to be. And it's going to be interesting between now and then, because I think the Fed used to have, or in certain chapters throughout history, has had a proactive approach. And certainly there's been times where it's been reactive, but I would call it super reactive right now, right? Like a rubber band being pulled back over the last, say, 3 years. If you didn't notice a little bit of inflation, you weren't paying attention. But what the government was doing was kind of manipulating the Kool-Aid formula a little bit to justify that inflation wasn't happening. They were kind of changing the mix of the goods they were looking at, and in order to keep inflation at an all-time low. And the rubber band has pulled back extremely far. And now we're seeing the ramifications for that, which is, that it's taken off, and they're going super aggressive in a reactionary stance to try to keep up with this inflation that just went berserko.
Yeah, man, it's I love what you said. It's totally going to be interesting to see what happens, right? No one has a crystal ball, and it's kind of unprecedented because, looking back, like 70s were a period of high inflation. And, really for most of my life, like, I don't think inflation has been that crazy, right? Like 2 or 3% a year, 1% a year. Some years it was maybe slightly negative, but 8%, 9%, 10% inflation, that's crazy. What's that gonna, what do you think that's gonna do? How can people combat that?
Oh man, well, that's a big conversation, because there's so many different, we're real estate guys. I work for a company. Inflation affects that company. It affects our employees. At Silicon Slopes Capital Partners. I think the lower level consumer here, I really feel for them, right? I took an Uber to the airport last week, and I was talking to the driver. the price of him to stay in business doubled, right? Like gas. That's a real thing. Forget about the rent and the milk and the groceries that he's buying. I feel for them because it's hard to it's hard to combat that. I mean, it's hard to prepare for that. So I think that's a really real thing, and that will also affect the real estate market, like you said. Eventually, there's a cap there where people can't afford the rent, or they're having to make a decision between, do I pay my rent in full or do I buy gas to get to work? And I hate that we'll be facing some of these questions, but I think with inflation where it's at, happening so quickly, there's no doubt some of that will happen, and that will have the trickle ramifications to every market, right? Those kind of all tied together. So that part's going to be really interested. But from a real estate investor standpoint, I kind of feel like a little bit of leverage has finally crossed over to our side as a buyer. People are pulling out of sell contracts, trying to rate lock really quickly on their financing because they know it's going up. That's nice because in the last 18 months to 2 years as a buyer, and we try to buy in every market, right, up or down. We try to stay active and buy smartly, but we have not had a lot of leverage. So I'm okay with seeing a little bit of that leverage come back to our side and hopefully get rid of a little bit of this buying frenzy that's just kind of been out of this world.
When people are irrationally exuberant like this, where, I mean, they're bidding, on the residential side, $50,000, $75,000, $100,000 over list price with non-refundable earnest money and no contingencies. And that just isn't sustainable, and it's not good, because most of these buyers, like, they're not even seeing the property, or they're seeing it for 10 minutes and then making 7-year decision based on a video walkthrough. And like, that's the kind of stuff where people get emotional, and that's where mistakes happen. And like, it definitely needs to slow down. This is healthy for it to slow down. It's healthy to have more inventory and not be getting crazy prices. Like, even on the multifamily side, right? Like, we were on a call yesterday and he was saying that people are playing this game where they're basically buying something off of a pro forma, meaning like, hey, this is potentially what all these units could rent for. And they're going, okay, cool, we'll pay that price as if that had already been done. And then they go and do it. And then they sell it to the next buyer saying, hey, rents are going to be even higher. Like, somebody's going to be left holding the bag on a short-term loan. And, there's obviously always opportunities in every market. Some markets you just always have to be invested, right? Because you never know when you're going to stumble upon a good deal. Like, I remember, buying a rental, gosh, it was like 4 or 5 years ago. And I was like, you know what? We're at the top of the market. Like, prices cannot go any higher. And I was paying like $225,000 for this house, which now is like, holy cow, what a bargain, right?
Yeah.
But at the time I was like, you know what? It doesn't matter, because in 10 years, if the market goes down, I have a tenant in there. It's going to pay the mortgage. I'm getting a good interest rate. And at the time it was like 5% interest rate, which is what we have now. Dude, like, long enough horizon in real estate fixes anything, right? So like, as long as people are buying prudently, they're buying good assets in good locations, like, I think they can ride through any storm if there's enough of a buffer called cash flow, right? That's why we like real estate. It's not like, stocks that we have zero control over. We totally have control over real estate.
Yeah, 100%. And what got me into real estate is I love investing, and I think stocks I still keep an eye on stocks. They're kind of boring right now. You get knocked on the chin, right? Like, even today, I actually picked up a little bit of Amazon because it dipped so low today. But yeah, real estate, you have control. And like, if you can just ride out that storm, and people really don't like to hear this, but if you've got a really good property, like, hey, my stock portfolio right now is not looking so great. Same thing can happen in real estate for a small window of time, but it's, do you have the right asset in the right location? And can you kind of weather the storm? How long is the storm going to be? And then what's the upside? And that's where you just can't touch real estate over time. You throw in some tax benefits there, and it's a no-brainer.
Yeah. Well, cool, man. I know you're always scouring, looking at articles. What else are you seeing out there?
Well, there's a war going on. I don't know if anybody noticed that. You know that I was just in Germany this week looking at some of our equipment that we're going to be installing in some of our new facilities. Really cool trip. But man, that's pretty darn close to the red zone
Yeah.
in the war, and they really interesting having conversations with them because number one, it's so close, but number two, I mean, their supply chain, we're talking about our supply chain issues over here, which affects so many things. But their supply chain, gas, their ability to stay in business, and keep the lights on in some ways is becoming near impossible. And so it was a real reminder being so close that man, it's a real thing going on over there that affects so many lives, not just there in Ukraine, which is unfortunate. But we've got to keep an eye on that. Again, I'm probably Mr. Apolitical. I like business and I like to make business moves. I find myself in DC every now and then talking to politicians, but we just need to know what's coming and we need to be part of the voice in shaping where it's going. And I don't think we can forget about what's going on over there either and how it affects us.
So, I mean, how can it affect us?
Obviously the supply chain, right? We've talked about time and time again, which is already in trouble. We can't get workers. It's a huge thing. If you own a business right now in the United States, I'm willing to wager that your number one issue is trying to find people. And that's not getting any better. But you throw supply chain constraints in this globalized world that we've worked for almost 20 years to build. And it's just sort of between COVID and now a war kind of been crumbling. It just makes stuff more expensive. If you can't get it, the good old supply and demand chart come out and it's going to make it more expensive. And so again, 8% inflation, normally you look out across the horizon and you say, what's kind of taper this inflation? Well, goods are coming back in, workers come back to work, and you kind of have a normal economic conversation. But right now, it may get worse in the supply chain of things, which means dollars, it costs more. Again, I forget what it was, a liter of gas in Germany. I think it was like $6.50 a liter.
Yeah.
I mean, it was like $200 to fill up a small car. I'm like, who can do that? So that's a problem. And the question is, how long is that going to go on?
Man, is that why you sent me a picture of you riding a bicycle next to a bunch of tulips?
It was an electric scooter. I'm a big fan. I got my first hybrid car recently. I am in on the electrical. This Elon Musk guy, he's on to something. I'm getting in on the electric, but that was fun.
It's going to be interesting to see what happens. That's for sure.
Jordy, a question of the questions, part of your business is obviously knee deep in the residential side of things. They're in Salt Lake with the brokerage. And I'm curious because you and I and our company, we often, even single family, we operate commercially, right? We buy portfolios. But I'm curious with some of this conversation and inflation and really thinking about that consumer, that person that is going to the gas station and filling up their car and really filling it. Those are the people that are buying houses through your brokerage. What's that conversation look like? What are they pausing? Are they stopping? Are they, having to get creative on financing?
This is where it gets interesting because it's easy for someone to say, like people can just stop buying houses. But the reality is everyone needs somewhere to live, right? So when interest rates go up to 2.5% in 90 days, that affects affordability. And that affects a lot of people's affordability because now all of a sudden 1% in interest rate, that affects someone's affordability by 10%, meaning their monthly payment, right? And people buy houses and cars based on monthly payments. Most people, obviously there's always the cash buyers, but most people are financing, especially if you're a young family, just getting started. And, that interest rate going up can affect it a lot. Interestingly enough, I think there's so many people right now afraid of inflation that they're going to real assets. So what we're seeing a lot is the new construction buyers are canceling their contracts because, what they contracted on 8 months ago that's getting close to completion now, they can't afford it because of interest rates. And so the builders are canceling that contract. And because our inventory is still low, they're jacking the price up another 15% based off from where they had contracted with buyer number one. And they're coming and getting a bidding war because, again, there's no inventory and things are getting bid up another 10%. So it's really interesting to see where things are going. And a lot of builders here locally in Salt Lake, they're doing the spec home model where they'll build it, they'll get it framed because wood prices are so volatile. Lumber prices are all over the place if you can get it. And so they'll get it framed, they'll pick out all of the interiors just to your supply chain point before, and they'll release it as a quick move-in home that's going to be done in 4 or 5 months, because a lot of people don't want to wait 9, 12, 18 months to build a house right now because they don't know if they're going to get the laminate they want or the countertops or, so it's kind of interesting, but there's definitely still people transacting. Our small sales team here, in the past week, we've sold 4 houses, but people are still transacting. I think we're going to see maybe a little bit more stabilization on price just due to interest rates going up. Again, people buy on payments. So maybe not the crazy bidding wars that we have seen the last year and a half. Again, it's not healthy to every time you're going out there to be like, okay, this house is listed at 750. What do we have to bid to get it? 800, 825, and just have these crazy bidding wars. It's healthy to be like, okay, I have a little bit of time to shop. Maybe I can go see 10 or 15 houses before making a decision on which one fits our family the best, because you have to have somewhere to live. And if you're going to buy something, even with rates going up and who knows how high they'll go, if you have a family, you got to have somewhere to live. You can't be living in a van down by the river.
Yeah, van life worked during COVID, but now everybody's got to get back to work. Yeah, interesting. I have a interesting, somewhat controversial maybe take on inflation too, that I've had some conversations with buddies lately. And I kind of look at the current inflation 2 ways. Number one is that a real figure that we're dealing with, and I don't know where it's going, up or down, and I don't really know how long, and we're sort of just going to keep an eye on it, and things cost more than they did because interest rates were at 0 and COVID and supply chains and everything just drove inflation crazy. But as a guy who's been buying real estate since 2009 too, I also have a hypothesis that not only were interest rates at 0 and flat for almost a decade, but a lot of things stayed flat for almost 10 years. So for my job, I travel quite a bit. And, so I go into San Antonio and I'm booking in a hotel room and, staying in a Hilton there. And, for 10 years, it cost $120. It didn't really move. And you go to book it today and it's going to cost like $280 or something, right? So my hypothesis is somewhere in there, and actually I would apply it to rent too, because I probably stayed pretty flat, not completely, but across all of our portfolio going back 12 years or so, and just taking a 10-year snapshot, that rent is pretty flat. And it should have risen like a nice, pretty linear chart, just a steady increase, but it didn't. And so now rather than that steady increase, we've got like a spike to a new plateau, a new normal or a new high or whatever. So part of my view of inflation is what I call, what should the real inflation be based off just everything not moving for 10 years. It's a little less alarming for me when I look at that. And, I push back on our property managers quite a bit, Jordy, this, because I try to look at where rents have been and I try to think about that real inflation and look beyond, okay, what are we getting right now? But where have they been over 10 years? Did they bump up 30% in the last 2 years? Or have they just been really flat, especially with these mom and pop owners? They've owned it for 20 years and they've moved it 7% over 20 years or something, right? Or less, sometimes 5%. It's like, well, that needs to skyrocket up to just where it should be, right? So factoring that in, there's no calculator for that. That's been fun and interesting too. And some guys really, like I said, some agree and some adamantly disagree, but it's a good, healthy conversation.
Yeah. Yeah. Well, I mean, different life experiences cause people to see things differently. So nothing wrong with that, but that's an interesting point. I've never thought about it that way. The crazy thing right now is, for years, if you would have bought a brand new car off the lot, you can project, hey, in 3 years, the average car is going to be worth, 60% of what you paid brand new. Well, because of the supply chain issues and people get in car wrecks, cars get totaled, like there's just a natural attrition with cars. All of a sudden you can buy a brand new car today, and depending on what car it is, like the Bronco, right? Like people are buying these from the factory.
Cool car.
Yeah, great car. Not as cool as the Jeeps, but
not as cool as my Jeep, but it's pretty cool.
But dude, people are buying them for like 65 grand, and then they're literally turning them around, putting $3,000 worth of accessories on it, and they're selling it for 90.
Yeah.
And even the dealers, like I was talking to a dealer the other day, and he was like, yeah, the best thing that could happen to us right now is someone that pre-ordered one of these Broncos cancels, because interest rates on cars are going up too, by the way. Like everything's getting more expensive, and some people, like if you're in your same job and you haven't gotten raises, or like you just can't afford it unless you move jobs, which I think we're going to see a lot of that, where really to adjust to what is normal now, like you're going to have to jump to a new job. Like, dude, I saw a sign at a fast food restaurant that was like $19 an hour. And I'm like, 3 years ago, they were paying people $9 an hour.
Totally.
Right.
Yeah.
Like it's crazy. But anyways, just back to the point, like there's so many variables right now flying at us that it's just hard to know what's going to happen.
Yeah. And things in this world, and I don't know, I'm almost 40 years old. So that's how long I've been alive. That's my frame of reference, even though I like to read about history and stuff. But I don't think it's ever been more volatile. I mean, with technology and information, we can get, whether it's correct news or fake news or you name it news, it is just super volatile right now. And it's going to be interesting trying to figure out how to factor that in the new world, looking at historical charts and looking at bond rates, interest rates, inflation rates, looking at whatever you want to look at historically, but putting that in the lens of today where things shift and happen. 3 months is like a long horizon today with how quick things go, right? And it's like 3 months, that's nothing on the radar of life. But that's another reason why I think it's fun. Maybe we get in here in a second to where do we think the next 3 to 6 months, like key things that we keep an eye on, where do we think they're going to go? But thinking that this is kind of a move that will affect the next 2 years, I don't really think we can think like that anymore. We literally have to have our long-term approach, and then we have to have our short-term actions, and you got to be nimble.
Yeah, no, it's a really good point. Even just to your point of, the next 3 months, then we can get into where we think things are going. I was quoted a couple days ago. So I found a portfolio lender here just because I've got some 1031 exchange money and I'm looking to buy some more rentals. They quoted me 5.125 for investment property loan, which is actually really good. That was a couple days ago. And today he called me and he's like, hey, I got some bad news. It's 5.5. And I'm like, whoa, that 0.5% makes a huge difference when you're borrowing, $500,000. It cuts into your cash flow a lot. But the crazy thing is what things are renting for, right? Yeah. Like my brother just listed, he has a townhouse. It's a 3-bed, 2-bath, 2-car garage townhouse that a year ago they were renting for $2,300 a month. Well, I think he just got at least for $2,800 a month. Someone got priced out of the market and they want to go rent something nice for a little while, right? Like, so it's just crazy. So, I mean, where do you think things are going the next 3 to 6 months?
Well,
Interest rates, prices,
yeah.
like what's an investor to do?
What's an investor to do for sure is, and this comes on the heels of lots of pain from me not doing this. That's when you learn your best lessons. So stay active in every market. Learn how to stay active in every market. And so with that, what's that look like today? Well, you can pay me for this advice, but interest rates are going up. You know, this year we're going to be dealing with interest rates going up. So as you're looking at properties, rate lock as quick as you can, because when you look at it in 30 days, you're probably going to have to underwrite a higher interest rate. And that affects, like you said, that affects your bottom line, your cash flow. Interest rates are going up, inflation's going up, going to continue to go up. Hopefully wages do increase throughout this. I think, you know, again, I have a team, and we have a lot of employees at the company I work for, and our wages are going up. I don't know if we can keep pace with it, but wages are going up. Prices, I think, are going to soften a little bit depending on the market you're in. Let's just take a couple of examples. I live in Park City. Technically, that's considered a luxury market. It's a hard stop in Park City. Like nothing's moving, and stuff wasn't sitting on the market for days. I mean, it was, you know, it's the same thing as everywhere else, even in Park City. Just 4 months ago, you know, it was a frenzy.
Oh yeah.
And
I remember looking up there for, you know, we were looking for another investment property it's a resort market. And it was like, man, if we didn't have an offer in like 4 hours, it was gone.
above asking,
Sold.
right?
Like,
Yeah.
yeah.
So
So
not even talking to you. Yep.
to hear it turn on a dime like that, where all of a sudden inventory sitting.
Yep.
So keep going.
Yeah. Yeah. So, and then let's go down to Salt Lake, where I would say less so, but I would call that a softening. And you're probably closer to it than me. I keep a little closer eye on the larger commercial market. You got your laser focus on the you know, residential market, but definitely softening. A little leverage is coming over to the buyer's side. I wouldn't quite call it 50-50 yet, because nobody knows how long we're going to be in this chapter, and we've just entered it. But I'd say softening over the next 6 months, and then the question we have, or I have, or what happens at the end of that 6 months? Do we go into, you know, a buyer's market at that point, or does the Fed realize that they were being a little too aggressive, and they kind of want to, in the words coming from them, or they're gonna taper back, you know, and eat and let things level off. That's going to be really telling, I think, coming out of it. But what we've been talking about this quarter, this year, you know, supply chain, inflation, soften, interest rates going up, that's going to be the norm for the next 6 months.
To your point, so I'm looking at inventory stats right now in Utah in general, not necessarily just Salt Lake, but in 2019, which I would say was still like pretty robust sellers market, there was 8,700 total listings, which, just for the listeners, you know, if you're not local to Utah, we've got about 3 million residents here in Utah. So 8,400 houses for 3 million people that's a tight market. And I remember 2019, it was, stuff would sit for a week or 2 or 3, and then it would sell. Nothing like the 2014 market, where, you know, as a realtor, you'd have to work a listing for 6 months and, you know, do 16 open houses and have to call all the neighbors. And, you know, like you just had to work it. Like right now, stick a sign in the yard, nothing is sold, which is great if you work with a lot of sellers. But if you work with buyers, man, you're having to show 20, 30 houses, and you're writing offers on every single one just to get one accepted. And it might not be their favorite house, right? Versus like 2014. I remember showing one particular client, we showed him 76 houses before he bought one. And, you know, he had options.
Yeah.
Where now you just don't have options. So fast forward to 2022, we have 2,800 active residential listings in the entire state. So we have a ways to go, I think, before we see a huge softening in prices, meaning, you know, maybe we're going down. I think we're going to at least continue to appreciate at least the rate of inflation, because like when I talk to the builder we represent, other builders, even guys flipping homes and doing remodels, it's tough to find labor. it's a tight labor market. And
very tough.
Plumbers are charging 3 times what they were in 2019. So everything's more expensive. Drywallers are more expensive. And, because gas is more expensive for all these guys that drive trucks and trailers and, tracos and like excavators, you can't like just not drive to work if you go and dig a hole to put a house in. So it's going to get more expensive. The cool thing with real estate, and I'll maybe put a little bow on it, because a lot of our listeners are just getting started on the path to financial freedom, or, maybe they're just building more horizontal or passive income because it gives you options in the future, right? You can put down as little as 10% with portfolio loans on investment properties, but usually even just 20, 25% down, and you can control that whole asset, right? So if, let's just call it a $500,000 house, if someone buys that and puts down $100,000 for easy math, and all of a sudden in 2 or 3 years, that $500,000 house is worth 600, well, they've now doubled their money, right? And rents have probably gone up and the loan's getting paid down. And if we have worse inflation, then it's going to look even better. Even though our dollar's just going down in value and, stuff's not necessarily worth more. But that's kind of the power of real estate. And it's why you and I are both real estate guys is, you can get a way better return off of that than you could in, speculating in Wall Street casino. So I think inventory, at least here in Utah, still has a ways to go before we start seeing price softenings. Now, obviously, interest rates are going to make a difference. So if they keep running up as fast as they've run up the last 90 days, that's going to be something to watch because that will slow stuff down. You're going to start seeing builders give concessions just to continue to move inventory because they've got a backlog. And then, the minute that stuff isn't going way over list, it's going to kind of normalize, which is good. But it'll be interesting to see if the pendulum swings the other way, where it becomes a full-blown buyer's market, right? Where we do see a correction in prices of 10, 20, 30%. Again, long-term, especially in Salt Lake, because of the geographic constraints that we have. And like, we've just got a pretty decent political climate. Like most people here aren't super nuts, like one way or the other. Like most people are level-minded, family oriented. It's not like we don't have any war zones in Utah. I think we're going to continue to see a net in migration of people who are leaving other states. There's a lot to do in Utah. We have all 4 seasons, a lot of hiking, a lot of mountain biking, skiing, lakes. There's just so much to do outdoors. And I think, COVID kind of affected everyone to force them to be like more into recreational activities than maybe they were before. And so I think we're going to have a very strong, robust market here in Salt Lake for a while, unless, if interest rates go to 9, 10% by the end of the year, which probably isn't likely, that'll affect stuff. It will certainly affect pricing. We might end up seeing, 2 or 3 families getting together and buying one house, houses with accessory apartments or ADUs. That's going to become a lot more popular just because we're almost tapped out on land. So that's kind of what I see in the next 6 months, maybe a little bit of breath, but overall our inventory, I remember when there was 15,000 active units listed, and that was before we had huge migration. And it's so low right now that I think it'll continue to be strong. Yeah,
good. I was thinking as we were going here today, I know you kind of are kicking this off and I'm sure momentum will be coming in quick, but it'd be great as we do the real estate rapid fire and you and I have questions and spitball. I love doing that. We're definitely continue to do that, but it'd be great to hear from the audience too. And maybe Keith could curate it for us from the team and get us some good ones. What can we sort of just run down real quick questions from the audience? Where do they think XYZ is going, or what do they think the max interest rate's going to hit? Just fun stuff that we could have a little fun with.
Email for the podcast is thefinanciallyfreeinvestor@gmail.com. thefinanciallyfreeinvestor@gmail.com. So if you guys have questions, Jay's more than happy to answer them. We're not going to give financial or investment advice or legal, but we can definitely, just give our 2 cents and our opinion, biased as it may be. But send us some questions and we'd love to answer it on the next real estate rapid fire. Well, with that, let's wrap it up, put a bow on it. Thank you so much for coming on for the Real Estate Rapid Fire, Jay. This is a phenomenal idea, and I'm excited to kind of bring people in the current market, what's going on every few weeks, so that, if someone's a dentist or a doctor, or, they work a job in wherever they're working, like they can kind of keep their finger on the pulse of the market. So this is a great idea. Thanks for listening in to another episode of the Financially Free Investor, and we'll catch you guys on the next episode. Thank you for joining me for another episode of the Financially Free Investor. If you found value in this episode or know someone who would find value in this information, please share with them, subscribe, and send us a review.